Welcome to the deep dive. We dive into complex info, pull out the key nuggets, basically giving you a shortcut to being really well informed.
Exactly.
And today, we're not just wading through balance sheets. We're looking at the strategy, the surprising bits behind the numbers for a major bank. Banking can seem, well, dense.
It definitely can.
But we're here to make it accessible, maybe even a bit engaging, find those aha moments.
Absolutely.
So today's deep dive is all about Union Bank of India, specifically their Q1 FY26 results for the quarter ending June 30th, 2025.
Right. And we've pulled this together from, quite a few places. The bank's earnings call, their official statements, the investor
The
slides.
questions we had going in. Yeah. Our mission for you listening is to basically pull out the most important stuff, give you a clear picture of this report.
And hopefully some insights you wouldn't get just skimming the headlines.
Okay, so let's jump in. Union Bank's Q1 results. What's the immediate takeaway? How did they start the financial year?
Well, if you look at the big numbers, the headline figures, it was actually a remarkably strong performance for Q1 FY26.
Strong how?
The standout, I think, is the net profit. It grew by 11.87% compared to last year. So that's 4,116 crore. Very solid start.
Okay, nearly 12% profit growth. And what about the efficiency metrics, like return on assets, return on equity? Do they tell a similar story?
You do, yeah. The return on assets, ROA, stayed strong at 1.11%, and that's actually above their own target of 1%.
Oh, interesting.
Yeah, so that tells you they're using their assets pretty efficiently to generate profit. And the return on equity, ROE, also looked healthy, 15.15%. Good returns for the shareholders there.
So profits up, returns are good. Is the bank itself, like its overall size, growing to total business?
Yes, total business grew about 5% year over year, reaching 22.14 trillion.
Wow, that's a big number.
It is. And if you break it down, their global loans, the advances, they were up 6.83% year on year. And deposits grew a bit slower, 3.63% globally.
Yeah.
So steady growth on both sides, lending and borrowing.
Okay, sounds pretty positive overall. But
But-
let's dig into something that definitely raised some eyebrows on the earnings call. An analyst asked about the bank going in the negative zone, despite, India's economy doing relatively well. What was that about?
Right, that's a great catch. And it really shows why you have to look, under the hood sometimes. The operating profit figure did moderate. It came in at 6,909 crore, which was down from 7,785 crore the year before.
Okay, so that looks like a drop.
It looks like one, but, and this is the key bit, the bank explained it wasn't really about core performance weakening. It was because the previous year's quarter had a big one-time income item.
A one-off.
Exactly, a one-off that just wasn't there this quarter in Q1 FY26. So if you strip that out, the underlying operations were actually quite consistent. It wasn't a dip in the core business at all.
Got it. That makes sense. Clears that up. Okay, what about another metric that softened a bit? The net interest margin, or NM. That came down too, right? Was that also sort of a strategic thing?
Yes, indeed. The NIM came down to 2.76%. That was down 11 basis points from the previous quarter and 29 basis points from the year before.
So nearly 0.3% lower year on year? Why?
Well, again, it seems quite strategic. Union Bank consciously decided to shed some high-cost bulk deposits. Those were down about 7% just between March and June this year.
Okay, getting rid of expensive funding.
Exactly. And on the other side, the lending side, they had RBI rate cuts immediately passed through to a chunk of their loan book. About 48% leaned to external benchmarks.
So lower income on some loans, paying less for some deposits. It squeezed the margin.
Precisely. But it looks like a deliberate choice. They seem to be saying, look, we'll accept slightly lower NIM for now to improve the quality of our funding mix and maybe protect profitability long term. It's about managing the cost of funds in a, tricky rate environment.
Right, a trade-off. Quality over just sheer volume. So what's the outlook then? Where do they see NIM heading?
Management gave some guidance. They expect maybe a 20 to 25 basis point hit to NIM for the whole year. So it could bottom out somewhere between, say, 2.60% and 2.65%.
Okay.
But they're also hoping for a cut in the cash reserve ratio, the CRR, maybe 100 basis points in the second half of the year. And that would help offset some of the pressure.
So that CRR expectation is key for them then. Something to watch.
Definitely. Managing cost of funds is crucial right now. Okay, and then there was Treasury income. That also looked lower compared to the March quarter, but I think there's more to that story too.
Yes, exactly the same pattern, actually. The reported number was 1,418 crore for June compared to 1,646 crore in March. Seems like a drop, but the March number included a huge one-time write-back. a 793 crore from something called special reserve provisions. Basically, money they'd set aside that they didn't end up needing.
Okay, another one-off boosting the previous quarter.
Yeah, right. So if you ignore that right back, the actual underlying profit from treasury activities increased significantly. It went from about 853 crore in March to that 1,418 crore in June.
Wow, okay. So in reality, a very strong quarter for their treasury desk.
Yeah, one of their best in a while, actually. Shows that they made some good calls on their investments.
So we've seen how they're managing costs, the nuances in income.
Yeah.
What does this mean for their growth plan? Where are they putting their lending efforts now?
Well, the focus is crystal clear. It's all about the RAM segments.
Right.
Retail, agriculture, and MSME, micro, small, and medium enterprises. Those collectively grew by a solid 10.34% year over year.
Double-digit growth there. Nice.
Yeah, and what's really significant is that these RAM segments now make up 56% of their total domestic loan.
Okay, that's a big chunk, more than half.
It is, and for a big public sector bank like Union Bank, which maybe historically leaned more on large corporate loans, this shift towards RAM is quite telling. It's a move towards potentially more stable, higher-yielding growth, diversifying their book.
Makes sense in this environment. Are there any specific parts within RAM that are doing particularly well?
Oh, yeah. The overall retail loan book itself grew by an impressive 25.63% year over year. That's huge growth. Reached about 2.29 lakh crore.
25%. What's driving that?
A big part seems to be gold loans.
Yeah.
Those went from 73,000 crore a year ago up to nearly 84,000 crore, so significant jump there. And MSME loans also showed really strong growth, up over 17.5% year over year to 1.44 lakh crore.
So real engines of growth of them right now, high yield segments too.
Definitely seems to be the strategy. Okay, so that's the lending side. What about funding? We talked about them cutting expensive bulk deposits. What does the rest of their deposit base look like?
Right, good question. So while the overall deposit growth was, moderate, that was, as you said, partly deliberate to cut those costly bulk ones. Where they did see strong growth was in retail term deposits. Those were up 12% year over year. That's the kind of stable, granular funding banks really like.
Okay, good. And KESA, the cheap current and savings accounts.
That ratio held pretty steady, stayed stable at 32.5%. So overall, it looks like they're actively managing their deposit mix to support those margins long term.
Right, optimizing the funding. Okay, let's shift gears slightly. Let's talk about risk, the health of that loan book. How's Union Bank doing on asset quality?
This is actually another real positive story in the results. They've continued to improve their asset quality quite significantly.
How so? What are the key numbers?
Well, the gross NPA ratio, that's non-performing assets, as a percentage of total loans, it came down to 3.52%. That's a drop of 102 basis points, over a full percentage point compared to last year.
Wow, that's a substantial improvement for a bank this size.
It really is. And the net NPA ratio, which is after they account for provisions set aside, that fell to just 0.62%, down 28 basis points year over year.
0.6, 2%, that's very low.
Extremely low. It tells you the vast majority of their stress assets are well provided for. And why this matters, for you listening, is that a cleaner loan book means the bank is more stable, has more capacity to lend, and faces fewer risks down the line.
Makes sense. And what about their buffer against potential future losses? The provision coverage ratio, PCR.
Also very strong. It improved further to 94.65%.
94.65.
Yeah, nearly 95%. That's a really robust cushion. And other indicators look good too. The slippage ratio, which tracks new bad loans forming, stayed below 1%. And the recoveries on old bad loans actually exceeded the new slippages in the quarter.
So recovering more than what's going bad. That's the ideal scenario.
That's exactly what you want to see. It suggests good control over asset quality.
Okay, but on the earnings call, there was also a question about an increase in something called special mention accounts, or SMA, particularly SMA2. Now, that sounds potentially worrying. What are SMAs and how did the bank respond?
Yeah, that's a fair question to ask. SMAs are basically watch list accounts, loans showing early signs of stress but not yet NPAs. SMA2 means payments are overdue by 61 to 90 days.
So a warning signal?
Kind of. It's a critical window. The bank acknowledged there was a marginal increase, but they didn't seem overly concerned. They pointed out that repayments are still coming in on many of these, some have government support helping them out, and also that Q1 is seasonally a bit weak for recoveries anyway.
Okay, so context matters.
Context matters. They also mentioned they took some extra provisions, about 46 crore, on standard assets where certain agreements between lenders weren't in place. And they reported 41 fraud cases amounting to about 180 crore. But crucially, they said those were fully provided for.
Fully provided. Okay. So while the SMA rise needs monitoring, it doesn't sound like a major red flag given the context and the provisioning.
That seems to be the assessment, yes. Prudent management, acknowledging the uptick, but having buffers in place.
All right, so managing current risks seems okay. What about positioning for the future? Beyond just this quarter's results, what strategic moves are they making?
Well, first off, their capital position is really solid. The CRAR, capital to risk-weighted assets ratio, is strong at 18.3%. And the core equity, CET1, is at 15.3%, both significantly better than last year.
Plenty of capital buffer.
Absolutely. And on top of that, the board has approved plans to raise another 6,000 crore in capital. So they're well armed for future growth and, any unexpected bumps in the road. A strong capital base is fundamental.
And technology, digital transformation seems to be a huge buzzword everywhere. Is Union Bank investing heavily there?
Oh, massively. They've earmarked 1,500 crore just this year for digital initiatives. That's a serious commitment.
1,500 crore. What are they actually doing with it? What's launching?
They've rolled out quite a bit already, things like Pan-India digital personal loans, digital vehicle loans, onboarding for the National Pension Scheme, enhanced UPI features like UPI Lite, UPI Global, stuff that makes banking easier and faster.
And is it having an impact? Are people using this digital stuff?
Seems like it. They mentioned generating over 32,800 crore in business through these digital lending journeys. And they onboarded over 6 lakh new customers digitally.
Wow.
So it's not just talk. And think about it from, your perspective as a customer. Faster loans, easier payments, managing things online.
Yeah.
These digital pushes aren't just good for the bank's efficiency. They genuinely improve the customer experience, makes them more competitive.
Definitely makes banking smoother. Beyond digital, what about sort of the broader societal impact? ESG, financial inclusion, are they active there?
Yes, they highlighted that too. They're involved in government social security schemes, things like life insurance, accident insurance, pensions for the unorganized sector, PMJJBY, PMSBY, APY, those kinds of schemes, reaching a lot of people.
Important for financial inclusion.
Very. And on the environmental side, the E in ESG, they mentioned significant lending to renewable energy projects, nearly 30,000 crore sanctioned. And also a specific scheme for electric vehicles, Union Green Miles, which has sanctioned over 1,000 crore.
Okay, so covering the S and the G and the E.
Seems like it. They also pointed out they ranked third among public sector banks in the latest Ease Reforms Index, which measures progress on various banking reforms. So, getting some recognition there too.
Okay, so let's try and wrap this up. Our deep dive into Union Bank's Q1 FY26. What's the big picture?
I think the picture is of a bank that's pretty strategically navigating the current environment. They're clearly shifting focus towards those higher growth, higher margin RAM segments.
Right, retail, agriculture, MSME.
Yeah. They're keeping asset quality very strong with low NPAs and high provisions. And they're investing a lot in digital transformation.
But accepting some pressure on margins in the short term as part of that strategy.
Exactly. It looks like conscious choices are being made, prioritizing long-term stability and profitability, maybe even improving the funding mix over just chasing top-line growth everywhere, especially in some corporate areas.
Okay, so that leads to a final thought, maybe something for you, our listener, to ponder.
Go for it.
Given this clear strategy, prioritize margins, focus on RAM, massive digital push, how might this change Union Bank's position compared to other big public sector banks over the next, say, 2-3 years?
Yeah, that's interesting. Will this focus make them more resilient or maybe more profitable than peers sticking to older models?
And beyond just the financial results, what actual tangible benefits could all this digital and ESG focus bring for customers, for their brand? Could it make them, a bank people actively choose in a sector that's changing really fast?
Good questions to think about. How does that strategy translate into real-world competitiveness and customer appeal down the line?
Something to mull over. We hope this deep dive gave you the insights you need. Thanks for joining us.